Hello everyone, I am Sabir Ahmed, your accounting tutor, and I welcome you to another lecture. In this lecture, we shall be talking about a chapter which is called Correction of Errors. As an accountant, we could make many different mistakes or errors while accounting for a business. In this chapter, we shall talk about the different kinds of errors that we can make while accounting for a business, their impact on the accounting system, and different ways to correct those errors so that we can ensure that the accounting system of a business is reliable. In today's lecture, we shall learn how to identify and correct errors that do not affect the trial balance. We will also learn how to identify and correct errors that affect the trial balance. We shall learn how to prepare a suspense account. And lastly, we are going to practice a sum that will test our understanding of the overall lecture. We are going to start with the errors that do not affect the trial balance. Now, first we need to understand why these errors do not affect the trial balance. The sole reason is that these errors that we are talking about affect both the debit and the credit side of a trial balance with an equal amount, which is why even though there are errors, the trial balance at the end still matches. There are 7 errors that have no impact on the trial balance: error of omission, error of commission, error of principal, error of original entry, error of transposition, complete reversal of entries, and compensating errors. We are going to talk about these errors one by one. First of these errors is error of omission. Error of omission is by definition an error that occurs when a transaction has been completely omitted from the books of accounts. So you see, you have not made any mistake or error while recording this transaction. The only mistake that you have made is that you forgot to include this in the books of accounts. For example, let's say we have a transaction. You received a check of $3,400 from GG Limited, and it says that we have not recorded any entries for this transaction. So it means that in order to correct this situation, or in order to ensure that the error of omission has been corrected, all we need to do is we need to enter the journal entries of this transaction in the books of accounts, and we are good to go. So all we are going to do is we are going to enter the journal entries for this transaction. So as you see, we have received a check of $3,400. Since we have received a check, bank account is supposed to be debited, and we have received this check from GG Limited, who used to be our trade receivables, a debit item. On payment, this debit item is going to be credited since they have cleared the payment, so they are no longer our trade receivable. So we are going to debit bank account by $3,400 as we have received a check and the bank balance has increased, and we will credit GG Limited account, our trade receivable, who has cleared this payment. We also need to include narrations if the question demands, and in this case the narration is going to be correction of error of omission, check received omitted. The next error is error of commission. By definition, this is an error that occurs when a transaction is entered into a wrong person's account. It means that instead of entering a transaction in Mr. A's account, you have included or debited or credited this transaction in Mr. B's account, wrong person's account. For example, we have a transaction which says a sale of goods of $450 to R. John has been debited into the account of R. Jonas. Now notice carefully. The person that we are talking about is R. John, the person who is related to this transaction. But instead of including this transaction in R. John's account, we have included this transaction in R. Jonas account. So all we need to do is cancel or omit this transaction from our Jonas account, who has been involved in this transaction by mistake or error, and we have to include this exact transaction in the account of our John to correct this mistake. So we have 2 things to do. 1, omit the transaction from our Jonas account, and 2, include this in the account of our John account. So all we need to do is first we need to credit our Jonas account since we have debited our Jonas account by mistake. So in order to omit a debit entry, we need to credit it. So our Jonas has been credited. And also we were supposed to debit our John account, which we did not because we by mistake have debited our Jonas account. So to correct that, we will include this transaction in our John account by debiting our John. So the journal entries will be our John account debit by $450 and our Jonas account credit by $450. And the narration for this is going to be sale of goods entered in wrong personal account now corrected. The next error that we are going to talk about is called error of principal, which is an error that takes place while a transaction has been entered into a wrong class of accounts. We need to understand the term class. Accounts can fall under different classifications. For example, motor vehicle account can fall under non-current assets accounts classification, and motor vehicle running expense can fall under the expense classification. For example, we have a transaction which says we have paid vehicle running expense of $800 by cash. Vehicle account, motor vehicle account has been debited and cash account has been credited by $800. It's true that we have paid by cash for this transaction, so cash account was supposed to be credited. So this transaction or this entry is correct. But look at the first entry. The first entry says that motor vehicle account has been debited. But did we purchase a new motor vehicle? I don't think so. All we have done is that we have paid for vehicle running expenses, which should be treated as an expense instead of a non-current asset. This is a revenue expenditure and not a capital expenditure. By debiting motor vehicle account, we are treating this transaction as capital expenditure. However, we have just paid the running expenses for motor vehicle, which should be treated as revenue expenditure. Now we have two steps to take. First, we have debited motor vehicle account by mistake. So we need to credit this account in order to omit the error that we have made. Second, we have forgot or we have mistakenly did not debit vehicle running expense, which was supposed to be debited as an expense or a revenue expenditure. So we are going to debit this account in order to correct our error. So the first step is debiting vehicle running expense by $800, which is actually a part of this transaction. And we are going to credit motor vehicle account by $800 because we have mistakenly added $800 in the debit side of this account, which needed to be omitted. The narration for this transaction is going to be correction of error of principal, payment of vehicle running expenses recorded in motor vehicle account.